What if I told you that $2.8 billion fleeing the Bitcoin market in just a matter of days might actually be, well, one of the most fascinating and maybe even necessary things to happen to the network this year?
I mean, it sounds totally counterintuitive.
Right. But picture this. It's late May, kind of creeping into early June of 2026. You open up your portfolio tracker, maybe you're grabbing your morning coffee, and the dashboard is just bleeding red.
Oh, yeah, the dreaded sea of red.
Exactly. Bitcoin, the undisputed king of crypto, is flashing these massive warning signs. We are talking about a brutal tumble, just crashing down well below the $71,000 mark.
And it isn't just like a momentary flash crash or a quick weekend dip. What we're really looking at here is a sustained structural bleed. It's fundamentally shifted the whole tone of the market.
Which brings us to the hard data we've pulled for this deep dive. We're looking at this unprecedented 9 to 10 consecutive days of net outflows from U.S. spot Bitcoin ETFs.
Yeah, 9 or 10 days. It's brutal.
It really is. I mean, that is the absolute worst streak we have seen in all of 2026 so far. And look, if you are looking at your screen and your portfolio is suddenly down 15%, it's a completely natural to feel your stomach drop.
Oh, absolutely. When you see a streak of red ticking down day after day, human instincts just takes over.
Right.
The immediate biological reaction is to assume, the ship is going down and you need to get to the lifeboats immediately.
Yeah, panic mode.
Exactly. But our job today is to kind of separate that visceral panic from the actual underlying mechanics of the market.
So the mission for this deep dive is to really figure out the reality of this situation.
Yeah.
Are we looking at a full-blown zombie movie scenario where institutional investors are just dropping their bags and fleeing for their lives?
Or is it something else?
Right. Or is this just a classic buy-the-dip opportunity that's like cleverly disguised as traditional financial drama? We need to know if the sky is actually falling or if the weather pattern is just shifting.
And to cut through all that noise, we're leaning on some highly verified, robust data sources today.
We're looking at capital flow data from Sosa Value and Farsight investors, alongside macroeconomic analysis from Bloomberg and CoinDesk.
The heavy hitters.
Yeah, exactly. Because by tracking where the money is actually moving, rather than just scrolling through, panic on social media, we can actually understand the complex machinery behind this drop.
I want to start by looking at the sheer scale of this. Because $2.8 billion walking out the door of these exchange-traded funds in, a week and a half?
Yeah, about that.
It's staggering. But before we get into the psychology of it, I really want to understand the actual plumbing. When we say outflows, what is the mechanical process happening behind the scenes that, forces the price of Bitcoin down?
That is a really crucial distinction to make, because when an investor decides to sell their shares of a spot Bitcoin ETF, they aren't just selling a paper promise to another buyer in a vacuum.
Okay, so what are they doing?
They are triggering a mechanical process involving entities called authorized participants, or APs for short. Okay, so these APs are like the middlemen connecting the traditional stock market to the crypto market.
Yeah, think of them as the market makers. When there is massive selling pressure on the ETF, meaning, way more people want to sell the ETF shares than buy them, the ETF actually starts trading at a slight discount to the actual price of Bitcoin.
Ah, I see.
So to fix that imbalance, the authorized participants step in. They buy up those discounted ETF shares, they redeem them directly with the ETF issuer, and in return, they receive the actual underlying Bitcoin.
Wait, and then they have to sell that Bitcoin on the open market, right?
Right.
To realize their profit and complete the arbitrage.
Exactly, which unleashes this huge wave of actual localized selling pressure on spot crypto exchanges, like Coinbase or Kraken.
Wow.
So that $2.8 billion in ETF outflows directly translates into billions of dollars of forced mechanical selling of Bitcoin itself.
Okay, so that turns a feeling of panic into a mathematical reality on the order books.
Yeah.
And to really grasp the severity of that 2.8 billion number, I feel like we have to look at the broader context of 2026, because January and February painted a completely different picture.
Oh, completely different.
Oh.
The year kicked off with immense enthusiasm.
Right.
We saw massive positive net inflows as all this institutional capital poured in, but this specific late May streak was so violent that the cumulative net inflows for the entire year shrank all the way down to roughly $536 million at one point.
So months of steady, methodical, institutional accumulation were essentially wiped out in 10 days.
Literally wiped out.
I want to know who was driving this, though. Like, is this a broad panic, Or are there specific heavyweights tipping the scales?
Well, if you look at the specific fund data, BlackRock's IBIT ETF is a prime example of where the bleeding is really concentrated.
Like,
Yeah, BlackRock is the undisputed titan of traditional finance. And during this 10-day streak, their IBIT fund saw individual days where hundreds of millions of dollars were redeemed just in a single day.
hundreds of millions. That tells us this isn't like retail traders cashing out a few $100 to fix their car.
Not at all.
This is wealth managers, family offices, and large-scale quantitative funds making a calculated choice to reduce their exposure to Bitcoin.
Exactly. It's the big money moving.
But if the biggest players on Wall Street are systematically walking away, I have to ask why. Because the core narrative I've heard for years, like the entire pitch for Bitcoin, is that it operates as digital gold.
Right, the safe haven narrative.
Yeah, it's supposed to be this decentralized, algorithmic safe haven and inflation hedge. When the traditional financial system gets messy, Bitcoin is supposed to be the fortress you hide in. So why is it bleeding out right alongside everything else?
Your question points to a massive ongoing identity crisis for the asset right now. Well, while the core philosophical community, the cypherpunks and early adopters, they definitely view Bitcoin as digital gold. But the institutional money flowing through these ETFs treats it entirely differently.
So they don't see it as a hedge?
No, right now, algorithmic trading bots and hedge fund managers are correlating Bitcoin much more closely with high beta risk assets.
Meaning they view it more like a high-growth tech stock or a risky software startup rather than a precious metal?
Yes, exactly. They view it as a tech proxy. And because it wears that risk-on label in traditional finance, it becomes hypersensitive to the macroeconomic weather.
Okay, so let's talk about that weather.
Let's look at the current perfect storm, starting with persistent inflation. Inflation simply isn't cooling down to the Federal Reserve's target rate as fast as the markets originally priced in.
But wait, if inflation means the dollar is losing purchasing power, shouldn't a hard-capped asset like Bitcoin go up? Why does sticky inflation hurt a hedge fund's desire to hold Bitcoin?
It all comes down to the cost of capital. When inflation stays high, the Federal Reserve is forced to keep interest rates elevated to try and cool the economy.
Yeah.
And institutional funds often operate using leverage, meaning they borrow money to amplify their returns. When interest rates stay high for longer than expected, the cost of servicing that borrowed debt becomes incredibly expensive.
Ah, so their monthly bills are basically going up, and they are forced to look for liquidity.
Bingo. They are forced to liquidate their most volatile, risky assets first to cover their positions and reduce their overall portfolio risk.
And right now, that means dumping their Bitcoin ETFs.
Exactly. Furthermore, you have rising treasury yields.
Right, the bonds.
Yeah. If a portfolio manager can buy a U.S. government bond and secure a guaranteed risk-free yield of around, say, 5%, the volatile, unpredictable world of cryptocurrency suddenly looks a lot less attractive for their clients' capital.
I mean, that makes total sense. They can get a safe, guaranteed return just by parking their cash with the U.S. government. Why take the risk on a Bitcoin ETF that might drop 10% on a random Tuesday?
Exactly. And then you add a strengthening U.S. dollar to the mix, which historically moves inversely to global liquidity and Bitcoin, and you have a very severe macro headwind.
So if a guaranteed 5% yield is pulling money out of the ecosystem, I have to imagine global geopolitical tensions are just accelerating that flight to safety. Like, our sources point heavily toward the Middle East right now.
Yeah, geopolitics is essentially providing the psychological spark to this macroeconomic tinderbox.
Right.
And we are looking strictly at how market algorithms and risk managers react to news flow here. The sources highlight recent escalations between the U.S. and Iran, specifically pointing to deep concerns regarding shipping security in the Strait of Hormuz.
Which is a massive global energy choke point.
Exactly. When geopolitical instability threatens global energy supplies, you get an immediate, massive surge in global risk aversion. Capital flies to the safest possible havens, which is usually the U.S. dollar and actual physical gold.
But not digital gold.
No, because, like we said, Wall Street currently classifies Bitcoin as a risk-on asset. So a flare-up in the Middle East means trading desks hit the sell button on their Bitcoin ETFs almost automatically.
Man, this is a wake-up call. If you are listening to this and looking at your crypto portfolio on your phone, you might feel like it exists in this purely digital vacuum. but your sats are currently tethered directly to U.S. Treasury bond yields and the shipping lanes of the Middle East.
It's all deeply interconnected.
It really is. But let's follow the money trail, because $2.8 billion doesn't just evaporate. It leaves BlackRock's IBIT, it gets converted back to cash. So where is that smart money actually going in 2026?
It's flowing right into the concept of sector rotation.
Sector rotation.
Yeah, the capital isn't leaving the financial markets entirely. It's just aggressively changing lanes. We are witnessing a massive rotation out of the cryptocurrency sector and directly into artificial intelligence and semiconductors.
Oh, wow.
Yeah, the sources specifically single out tech behemoths like NVIDIA, which, just continue to post explosive earnings.
So they are just chasing the immediate momentum.
Well, institutional fund managers are mandated by their clients to generate yield. They literally cannot afford to sit on an asset that is moving sideways or bleeding due to macro pressure when another sector is out there minting millionaires overnight.
Right. They have to perform.
Exactly. And right now, the verifiable explosive revenue growth is happening in the AI infrastructure space.
So this isn't necessarily a fundamental rejection of Bitcoin's technology or its long-term future. It's just a tactical reallocation. They look at their spreadsheet, take their profits or cut their losses in crypto, and then deploy that cash to buy AI chip manufacturers because that's the hottest game in town.
It is a totally calculated strategic rotation. They are rebalancing their portfolios based on quarter-to-quarter momentum.
Okay, so Wall Street is rotating out, the ETFs are bleeding billions, and the macro environment is suffocating risk assets. If you only looked at traditional stock market tickers, you would totally assume crypto is heading for a deep winter.
You would, but
But our sources highlight this massive counter-narrative, and frankly, I think this is the most fascinating part of the data today. The blockchain itself is telling a completely contradictory story.
this is where we really have to look at the on-chain reality to get the full picture.
Right, because if the big traditional finance funds are dumping $2.8 billion worth of Bitcoin, someone has to be on the other side of those trades. A sell order inherently requires a buyer who is actually absorbing this massive dump of supply while the price drops below $71,000.
The on-chain analytics reveal a glaring, almost ironic contrast. The data clearly shows that long-term holders, the demographic analysts refer to as LTH, which basically represents addresses that haven't moved their coins in over 155 days, they are aggressively accumulating Bitcoin right now.
Wait, let me make sure I'm hearing this correctly. Wall Street, the supposed smart money with all their algorithms and Ivy League analysts, is panic selling their Bitcoin at a discount directly to the crypto natives and retail veterans who are quietly buying it up.
That is exactly what the data suggests.
That's wild.
The entities that have survived multiple boom and bust cycles are treating this Wall Street exodus as a massive discount event. And furthermore, if you look at the supply of Bitcoin currently sitting on exchanges, meaning coins that are readily available to be sold, it is sitting at historic lows.
Really? Because if this was a true generalized market capitulation where everyone believed the asset was doomed, you would see everybody rushing to send their Bitcoin to an exchange to cash out to fiat.
Exactly. But we see the exact inverse from the crypto natives. They are buying the Bitcoin that Wall Street is dumping. They're pulling it off the exchanges and transferring it into cold storage hardware wallets.
They are locking it away.
Yes, they're securing it.
So the foundation of the network is actually solidifying, even while the surface price looks incredibly shaky. But how do we explain this massive behavioral disconnect? I mean, why is an ETF buyer panicking at a 10% drop while a guy with a hardware wallet is aggressively buying?
To explain that, we have to look at behavioral finance and specifically how the wrapper of an asset changes human psychology.
The wrapper.
Yeah, how it's packaged. The source material references the pioneering work of Nobel laureate Daniel Kahneman and various papers from the Journal of Finance regarding a phenomenon known as herding behavior.
Okay, so what does herding behavior actually look like in the mechanics of an ETF?
Well, herding behavior is basically the psychological instinct to abandon independent analysis and seek safety in the crowd. Think about the friction or the lack thereof in an ETF.
It's just a ticker.
Right. It sits in your traditional brokerage account right next to your Apple stock and your S&P 500 index fund. It is incredibly easy to liquidate. You don't have to understand blockchain cryptography. You just see a red number in your app.
Oh, I see.
When the market gets turbulent, you see reports of outflows, you assume the crowd knows something you don't, you get spooked, you click one button to sell, and boom, you join the herd.
The ease of access actually facilitates the panic. It's like It's like the difference between being on a massive luxury cruise ship versus a small, sturdy lifeboat.
That's a great analogy.
Right. Because when the macroeconomic weather gets slightly choppy, the cruise ship passengers, the ETF buyers, they stampede for the exits because they're loosely attached to this giant financial product. But the lifeboat captains, the long-term holders who self-custody, they expect the waves. They understand the engineering of their boat, so they just keep rowing.
Exactly. The self-custody process just inherently requires a higher baseline of conviction. Because the crypto native understands the underlying mechanics of the blockchain, they are largely insulated from the Wall Street herd mentality.
They don't get spooked by the news.
Right. They process a macro-induced price drop not as a structural failure of Bitcoin, but simply as a temporary liquidity crunch.
That makes so much sense. The packaging of the asset completely dictates how the investor behaves with it. Okay, so we've seen the traditional finance herd panic, and we've seen the on-chain veterans holding the line and hoarding the supply. I want to kind of zoom out now.
Okay, let's zoom out.
If we look at the grand historical timeline of Bitcoin, how does a 10-day streak of ETF outflows in 2026 actually stack up?
Well, it is vital to look at historical precedent here so we don't succumb to recency bias. Have we seen consecutive outflow streaks of this magnitude from these exact same ETFs before? Yes.
We have.
Oh, yeah. The data shows highly similar panic events in both 2024 and 2025.
And the network didn't collapse.
Far from it. Those previous periods of severe outflows were subsequently followed by incredibly resilient price rebounds. It's also really crucial to maintain perspective on the net aggregate data.
Right, the big picture.
Exactly. Yes, we are analyzing a $2.8 billion outflow streak today. But since these spot ETFs launched back in January of 2024, they have still accumulated tens of billions of dollars in positive net inflows.
Wow, so the overall trend is still way up.
The overarching multi-year trajectory has been massive institutional accumulation, just temporarily punctuated by these violent macro-driven pullbacks.
You know, I keep hearing the veterans say that the fundamentals haven't changed, despite the price tumbling below $71,000. But what does that actually mean in practice? Like, if the price is down, hasn't something broken?
Not at all. Price and fundamentals are two completely separate metrics. The fundamentals refer to the code, the network security, and the monetary policy.
Right.
Has the 21 million hard cap on supply changed because BlackRock clients sold? No. Did the network stop processing blocks? No. The systematic reduction in new coin issuance from the recent halving is still hard-coded into the protocol.
So no matter how high U.S. inflation gets, and no matter how many times the Federal Reserve pivots on interest rates, no central authority can arbitrarily print more Bitcoin to bail out a bad position.
Which is the entire core value proposition. The institutional infrastructure continues to grow. I mean, Wall Street might be tactically trading it like a volatile software stock right now, but they are simultaneously building all the plumbing, the custody solutions, the clearinghouses to integrate it permanently. None of that architectural progress was undone by a 10-day outflow streak.
That brings to mind a classic quote from the legendary economist John Maynard Keynes, which one of our sources actually included, and I think it's perfectly terrifying. The market can remain irrational longer than you can remain solvent.
It is a phenomenal reality check for anyone using leverage. For a short-term algorithmic trader, this high volatility equals immense risk.
Because they're borrowing money.
Exactly. If you are trading Bitcoin with borrowed money, an irrational, geopolitically driven market swing can completely liquidate your account. Even if your long-term thesis about Bitcoin's dominance is eventually proven entirely correct.
But for the long-term holder, you know, the person just quietly stacking into cold storage, they don't care about insolvency because they don't have any debt on their position.
Right, they can just wait it out.
They just use the irrational fear of the Wall Street herd to acquire a scarce asset at a deep discount. Which brings us directly to you listening to this deep dive right now.
Yeah, what's your strategy?
Right. If you're looking at a 15% drop in your portfolio, you might be rolling your eyes at the idea of herding behavior. I mean, it just feels like you're losing money. But this is the exact time to do a ruthless audit of your own strategy. Ask yourself, are you running a disciplined, long-term dollar-cost averaging strategy where you mechanically buy a set amount every week, completely ignoring the noise and the geopolitical headlines?
Or are you secretly just trading on FOMO?
Exactly, letting your emotions be dictated by the Wall Street herd.
It is arguably the most important self-assessment an investor can make, and we heavily encourage you to verify everything we've discussed today. Go to the primary sources.
Absolutely.
Look up the daily flow data for BlackRock's IBIT or Fidelity's FBTC. Track the institutional capital yourself and watch how it moves in relation to the broader stock market.
Do your own research, always.
Oh.
But as we wrap up, I want to leave you with a final, slightly provocative thought to mull over something that really builds on this idea of Wall Street's herding behavior infiltrating the crypto space.
Oh, this is a great point. The lingering question is this. We know that Wall Street spot ETFs have successfully bridged massive amounts of traditional capital into the Bitcoin network.
Right, billions of dollars.
But by importing all that capital through these highly regulated, easily liquidated wrappers, have they also permanently imported traditional panic-driven herding behavior into the ecosystem?
Oh, wow.
Right. Is Bitcoin's fundamental DNA slowly transforming from a decentralized, uncorrelated rebel asset into just another easily spooked Wall Street tech stock?
That is the billion-dollar question. Has the cruise ship completely overtaken the lifeboats? We're going to have to watch the on-chain data over the next few months to really find out. But remember, in the financial markets, just like in a zombie movie, the initial stampede of panic is always the most dangerous part.
Yep, the herd is dangerous.
But the macro storms eventually pass, the panicked herd tires out, and those who study the mechanics, understand the fundamentals, and practice relentless patience are usually the ones who make it to the end credits. Stay curious, keep learning, and we'll see you on the next deep dive.